Good morning, Mr. Kilcourse from Allianz Global Investors. Which are the perspectives for U.S. economy and where can investors find opportunities in this moment?
So our team's outlook for the U.S. economy right now remains positive. You continue to see positive trends in economic statistics, whether it be unemployment, consumer confidence, consumer confidence in housing. So the U.S. economy from an economic perspective continues to become and look like it's on more solid footing. I think case in point around that is the continual talk of the fact that the U.S. Fed is getting more in the camp of potentially increasing interest rates at some point soon. They would not be doing that if they did not feel that there was stability in the U.S. economy. When you start then taking a look at company-specific examples in the United States of why we're so positive, if we look at what we saw in the second quarter, you continue to see U.S. corporations exceeding earnings expectations. You had 67% of U.S. corporations beat analyst expectations in the second quarter, and that's above the long-run historic average. The average beat was by about 6%. So if we look at how U.S. corporations are doing, they're continuing to meet or exceed earnings expectations, and that's a positive when you look at the fundamental case for company-specific opportunities that are present in the U.S. marketplace today.
What is the strategy of Allianz Income and Growth Fund, and what is the investment process?
So we think that the Income and Growth Fund is a strategy that presents a really unique opportunity to clients. The Income and Growth Fund is a strategy that really is the culmination of our team's skill set, and it's a product that utilizes a multi-asset approach to generate to clients a consistent distribution, and that is for our AM US dollar share class. That consistent distribution is able to be earned because of, again, the multi-asset approach of investing a third of the portfolio in high-yield bonds, a third of the portfolio in convertible bonds, and a third of the portfolio in U.S. large-cap equities. On that equity sleeve, we have the ability to opportunistically write covered calls. That call portion of the portfolio allows us to smooth out our distribution by collecting in the option premium, but also helps to buffer downside risk when the equity markets roll over. So what you get over the long run of this strategy, when you think about the makeup of the underlying asset classes, is a portfolio that delivers an asymmetric risk-return profile, where you're going to get equity-like returns, but do so at lower volatility. So over the long run, you've gotten about a beta of about 0.75 of the strategy relative to the S&P 500. So again, equity-like returns, lower volatility. The other interesting element of the strategy, I think that makes it resonate in today's marketplace, is the fact that if you think about high-yield bonds, you think about convertible bonds, and you think about equities, these are all three asset classes that historically have held up well in past periods of rising interest rates. So you have a strategy that's going to deliver equity-like returns, and you have a strategy that historically, from an asset class perspective, has been less interest rate sensitive. And I think that's why the strategy has really garnered a lot of attention from investors in today's present market environment.
From the equity side, could you name some companies where you see value in this moment?
So, if we look at some of the names that we've been investing in, and again, going back to a previous question about some of the strength that we're seeing and some of the things that we're so positive on, I don't think you need to look much further than, a name like Google in the marketplace. Google had record-setting earnings, and correspondingly, the stock has done phenomenally well. That's the type of name that we are looking for, where you're able to get a good growth story. We are trying to identify names that have the ability to meet or exceed earnings expectations, try to identify companies based on a forward-looking approach that are going to be positive on a going forward basis. And then when you get a name like Google, which clearly everybody knows, and they are able to deliver the earnings that they did to the marketplace, clearly performance was very strong shortly thereafter. So that would be, I think, one of the more recent examples of a name in the portfolio that when you think about our approach of trying to identify these companies that can meet or exceed earnings expectations, of when you get a name right and it does click and do the things that you would hope it would do, it's going to clearly have the ability to perform well in that type of environment.
Thank you.